effort to do better with our money this year, so we're happy to have Coach Pete back with us to help us back to financial health. Thank you so much for being here.
Always good to be here.
Yes, so today we're digging into workplace retirement plans. So what is the basic information that we should know about these plans?
Well, number one, don't depend on your employer to help you save for retirement. So a lot of people say, well, I'm not saving for retirement because my employer does not offer a 401k or a 403b or a TSP, whatever the options are. Well, you can go get your own IRA.
Yeah.
Or you can save on your own in the stock market or even with Bitcoin, that kind of thing. But I don't advise Bitcoin because I don't have any myself, and it's way up there now. But we like to blame other people these days in society.
Yeah.
Just turn the TV on.
Right.
There's like Jerry Springer show or whatever, all these different shows about people blaming other people, but we need to blame ourselves if we don't have our own retirement plan. And if your employer doesn't offer one, get in their face and tell them you want one.
Yeah, and even if your employer does offer one, you can still get more on the side, right? So how do these workplace retirement plans really work?
Well, they're good. Like most people watching probably have a 401k. If you're with a big enough employer, they'll have a 401k. 401ks are expensive to administrate for small businesses because it costs a lot of money to do it. That might be why they don't have one. But a 401k, if you do have one, take advantage of it. Many people watching have a plan available to them that has a match.
Right.
That means if you put $1 in, maybe your employer puts 50 cents in for every dollar.
Free money.
Or $1 in or whatever. But a lot of people don't even put the money in to get the match. So if you don't put money in, they're not going to match it. So you're costing yourself a whole lot of money by not taking advantage of that match.
Yeah, that free money. It's right there. You just take it. So you always recommend keeping a certain percentage of our investments in a non-risky place. Would you consider these workplace retirement plans a non-risky place?
No, they're risky, but here's what it is. When you're working, you want the market to tank. You want the market down because you're putting money into your 401k. Therefore, if the market's down, you're getting a lot more shares for a lot less bucks.
Okay.
So magically, when you get ready to retire, you want the market to rise up. It's not going to happen like that a lot of times, but don't get depressed if the market's going down. Because remember back in 2007, 8, 9, the market was tanking. A lot of people stopped putting money into their 401k because they were worried about it going down in value. But that was the best time to be piling money in, probably increasing what you put in, because you would have got a whole lot more shares inside your 401k. Now, another question a lot of people ask is, gosh, this 401k has so many options, 30 different options where I put my money. What should I do? Well, one thing you need to do is not do whatever your neighbor's doing.
Okay.
You need to get an individual review, and like you said, the safe money, after you get close to retirement, like if you're 50 or older, now you need to start looking at safety aspects. We call it the core and explore. And so if you're 55 or older, and if you're retired, or 59 and a half and still working, you can roll some of your money tax-free out of the 401k and into your own individual retirement plan that does have a lifetime income. Because the big problem with the 401k, there's no lifetime income. It's just a lump sum.
Okay.
So it's up to you, unfortunately these days, to make it last and to make the decision to get it into a place where now you have a lifetime income instead of just a lump sum.
So what's the bottom line for people at home with these workplace plans? Should they be buying into them? Should they also be buying into other plans as well?
Yeah, both. Take advantage of the 401k, especially up to the match. And then maybe get your own IRA or put some money in the stock market or dedicate an account for retirement. Because the magic here is the more you have in retirement, the more happy you're going to be in retirement.
I agree.
And the less risk you have once you retire, the more happy you're going to be if the market tanks. So we do this for people. We monitor the 401k when they're putting money in for them, tell them what choices they should be using, but more importantly, tell them how to get that lifetime income, that personal pension. We used to work for companies. Well, I didn't, but I mean, we're talking about our grandparents worked for companies for 30, 40 years. They would retire, and then the company would continue to give them a paycheck called a pension.
Right.
Cut that out years ago. Most of them did when they launched the 401k. Now the burden is up to the consumer to put money into 401k, but all's not lost, because once you do that, if you have some money put aside, we can build for you your very own dedicated retirement plan.
Very important. Thank you again for all the helpful advice, Pete. We appreciate it. If you guys are interested in receiving a financial review of your current investments from Coach Pete and his team, text CBS 17 to 21000 or call 888-919-9001.